Welcome to the Deep Dive. Today we're venturing into South Asia. We're looking specifically at India and Pakistan, exploring some really significant economic and geopolitical shifts happening
Yeah,
there.
that's right.
We've got quite a bit of analysis here, looking at both the sort of geopolitical landscape and the hard economic data.
Hmm.
And our mission really is to distill what all these changes mean for investment
Mm.
and, maybe more importantly, for how you can manage risk in your portfolio.
Yeah, risk management is key here.
What really grabbed my attention straight away in our sources is the almost polar opposite direction these two countries seem to be heading in. It's quite striking. Okay, let's unpack this divergence.
It is a stark contrast, isn't it? You've got India, which really appears to be gaining some serious traction, seizing new global opportunities.
Right.
And then there's Pakistan facing this, persistent set of economic challenges and, frankly, vulnerabilities.
Yeah.
Really understanding the dynamics of this split, that's what we're aiming to get into today.
Okay, let's kick off with India's side of the story then. One of the really pivotal developments highlighted in the analysis is this new free trade agreement between India and the UK.
Ah, yes, the FTA.
And here's where it gets particularly interesting, I think. This deal is set to eliminate tariffs on, well, an astounding 99% of Indian exports.
99%, that's huge.
It really is. That's a potentially game-changing level of access to the UK market.
And what's particularly insightful here isn't just, the headline number, impressive as it is, but the kind of strategic alignment this could create.
How so?
Well, it potentially positions India as an even more attractive manufacturing hub, maybe for companies aiming to access not just the UK, but perhaps indirectly EU markets too, post-Brexit.
Interesting angle.
Our sources specifically point to sectors like textiles, footwear, gems, and specialty chemicals as major beneficiaries.
Right.
By phasing out these tariffs, Indian exporters just gain a considerable price advantage in the UK. Simple as that.
Yeah, that makes sense. And it feels like this agreement comes at a really opportune moment for India, too.
Hmm.
The analysis suggests this could serve as a pretty significant counterbalance to some of the earlier headwinds they faced, with tariff issues in the U.S. market.
Exactly. So for Indian companies with a strong export focus towards the UK, this looks like a substantial boost, a real positive.
Right.
And if we connect this to the sort of broader currents of global trade, this agreement really underscores India's proactive stance. They're forging new economic partnerships, diversifying their export destinations. It's a clear signal of intent.
And this positive momentum for India, it seems to extend beyond just trade deals. We're seeing a growing trend among major tech companies considering India for manufacturing.
Yes, the Make in India push seems to be resonating.
The potential for Apple, for instance, to shift even more of its iPhone assembly for, say, U.S. shipments from China to India. That's a really significant development being discussed.
It really is. And this potential shift, it truly highlights the increasingly compelling conditions India is offering now.
What are the drivers there?
Lower tariff barriers, combined with a range of, frankly, quite attractive incentive programs, they're clearly making India a more appealing manufacturing base for global giants like Apple.
And the ripple effects of a move like that could be substantial, couldn't they?
Oh, absolutely.
Our analysis points out that smartphone assemblers, especially in states like Tamil Nadu and Karnataka, they're already seeing a surge in export orders.
Yeah, that's already happening.
It's described as a kind of virtuous cycle, this positive feedback loop. More production leads to more investment, leads to more jobs.
Exactly, and that stimulates demand further. It's not isolated to just one company or one sector either.
Right.
This kind of manufacturing activity, it has a cascading impact. It goes through the entire supply chain, the broader economy, driving demand for components, logistics, a skilled workforce. It's a big deal.
Okay, now let's pivot a bit to the financial landscape within India. The Reserve Bank of India, the RBI, they've been quite active.
Managing liquidity.
Yeah, through tactical bond buying. And we're seeing this gradual downward trend in interest rates. Seems like it's fostering a more conducive environment for businesses maybe looking to invest and expand.
Well, it's kind of multi-layered. The bond buying, that helps ensure there's enough liquidity sloshing around the financial system.
Okay.
And the slightly lower interest rate environment, that obviously makes borrowing cheaper, more accessible for companies.
So they're taking advantage.
It seems so. Our analysis indicates that corporate borrowers are successfully raising capital at pretty attractive yields. And that can provide, further impetus for investment, for expansion plans.
And adding to this, the government's recent direct tax exemptions, they're projected to give a notable lift to the economy, too.
Yeah, the fiscal side kicking in.
The estimates we're seeing suggest a potential, what, 0.6 to 0.7% increase in GDP in fiscal 2025-26, largely fueled by increased consumer spending.
Seems plausible. It looks like a coordinated effort, really. Stimulating activity through multiple channels, monetary and fiscal.
Right.
These fiscal measures, they're specifically designed to put more disposable income directly into consumers' pockets. The expectation being this translates into more spending and therefore stronger economic growth. Pretty standard stuff, but potentially effective.
What's also interesting, though, is despite some, ongoing regional tensions, investor sentiment towards India remains remarkably resilient.
That is noteworthy.
Our sources highlight that the main indices, the Nifty 50 and Sensex, they've shown considerable stability. And foreign investors, they injected over 14,000 crore in net inflows in early May alone.
Wow, that's significant.
It really is.
Well,
It feels like a significant display of confidence in the Indian market despite the noise.
I think this robust investor confidence, it really speaks to the underlying strength, maybe the long-term growth story that India's been building.
Yeah.
Despite those short-term geopolitical worries, international investors seem to be focusing on the fundamentals, the economic drivers, and that potential for sustained future returns.
Okay, so that paints a fairly optimistic picture for India overall. Now, let's turn our attention across the border to Pakistan. Here, the economic situation, according to our analysis, presents a very, very different set of challenges.
Yeah, the contrast is quite striking.
How bad is it?
Well, Pakistan is currently grappling with a really substantial level of external debt. We're talking over $131 billion.
Yeah.
And compounding this, their foreign exchange reserves are, frankly, alarmingly low, barely enough to cover 3 months' worth of imports.
3 months, that's cutting it fine.
Very fine. It creates a very vulnerable position, especially if, any escalation in geopolitical instability were to disrupt external financing flows.
That extremely low level of reserves really stands out. It suggests a very limited capacity to absorb shocks, right?
Yeah.
Or even just finance essential imports if that external funding tap gets tighter.
Precisely. And this underlying vulnerability, it hasn't gone unnoticed. It's been flagged by international rating agencies.
Like Moody's.
Yeah, for instance, Moody's has specifically highlighted the risk that, prolonged geopolitical standoffs could lead to a cutoff of crucial external funding.
Which would just exacerbate Pakistan's already significant economic difficulties.
Exactly. It's a precarious situation.
Pakistan's reliance on the IMF, the International Monetary Fund, that's another critical aspect highlighted in our sources.
Yep, deep reliance, yeah.
They recently got a $1 billion disbursement under the Extended Fund Facility, the EFF.
Correct.
But the overall tone in the analysis suggests this is more like a temporary lifeline, not really a sustainable solution.
That's a key distinction, I think. While the IMF funding provides some immediate, albeit temporary, relief, it really just underscores Pakistan's deep dependence on official financial support.
Right.
It's just not a viable long-term strategy unless they implement significant underlying economic reforms.
And it appears India's stance within the IMF isn't exactly helping Pakistan's case either.
No, that's another layer.
Our analysis mentions India's vocal objections, which haven't helped Pakistan's efforts to secure further financial assistance.
No, it adds a layer of geopolitical complexity to the existing economic challenges. And future disbursements from the IMF, they're contingent upon Pakistan undertaking politically sensitive structural reforms. Big ones.
Which are always difficult.
Always. And without these reforms, the country's just going to continue facing significant hurdles. Servicing its debt, attracting much-needed private capital investment, it all gets harder.
Then there's the currency risk. That seems persistent.
Very much so. The Pakistani rupee has already depreciated significantly this year. What is it, nearly 8%?
Yeah, around 8% year to date.
And with those foreign exchange reserves dwindling, it just sounds like the pressure on the currency is only likely to intensify.
More downside potential.
That's a very real concern. Further depletion of reserves will likely lead to even greater depreciation pressure on the rupee.
And that has knock-on effects for investors.
Absolutely. Significant implications for anyone holding local currency bonds or equities. Your potential returns can get substantially eroded by currency losses. It's a major risk factor.
Okay, so keeping these very different economic pictures in mind, let's talk portfolio. What does this all mean for someone looking at their investments? Let's start with India. Based on our analysis, what kind of strategies might be worth considering?
Okay, for India, the focus should probably be on companies that are well positioned to, capitalize on these positive trends we've discussed.
Like the exporter?
Exactly. Export-oriented businesses, particularly those in the sectors getting a boost from the UK trade deal. Also, suppliers within that expanding tech hardware manufacturing ecosystem, they appear promising.
And what about broader vehicles, like ETFs or mutual funds?
Well, considering overweight positions in India-focused ETFs or mutual funds could be a prudent way to get diversified exposure. Seems reasonable given the outlook.
Any particular sectors within that?
Within those, our analysis suggests paying particular attention to sectors like consumer discretionary, industrials, and business services.
Why those?
They're expected to benefit from both, robust domestic demand and those increasing export opportunities. Kind of a double win potential.
Makes sense. What about the fixed income side for India? Bonds.
Yeah, the potential for gradual interest rate cuts in India, it makes local currency debt potentially quite attractive.
So rupee bonds.
Rupee-denominated bonds or perhaps local debt funds could offer appealing real yields, especially if inflation stays under control.
Okay.
And the continued inflows of foreign capital we talked about, that could contribute to the stability of the rupee, potentially adding another layer of benefit for investors there.
Okay. Now, shifting focus to Pakistan, the investment advice here seems quite different, leaning heavily towards caution.
Ah, yes, indeed. The elevated risk of sovereign default, it just necessitates a very cautious approach. There's no way around it.
What does that mean practically?
For the majority of investors, frankly, underweight exposure or even complete avoidance of Pakistan-linked investments would probably be the most prudent strategy right now, just managing risk.
And if you already have exposure?
If there is existing exposure, definitely consider currency hedges. Mitigate that potential downside from further rupee depreciation. That would be advisable.
Okay. And for those very few who might still want to maintain some minimal exposure, maybe for specific reasons.
Look, for those with a very specific mandate and crucially a high risk tolerance, maybe focusing on ultra short duration instruments could limit some risk, or employing options-based hedging strategies to limit potential losses.
But not for the average investor.
No. And for broad diversification within emerging markets generally, our analysis strongly recommends looking elsewhere right now, markets with stronger policy buffers.
Such as?
Think about regions like ASEAN or parts of Latin America, perhaps. Places with a bit more stability and resilience.
Got it. So to recap then, the key takeaways from our deep dive today, they reveal these really contrasting paths, don't they?
Absolutely. Polar opposites, almost.
We see India with significant growth potential, seemingly driven by ongoing reforms and these new trade opportunities.
Right, a positive trajectory overall.
While Pakistan continues to grapple with pretty substantial economic vulnerabilities and ongoing policy uncertainty.
That's a succinct and accurate summary. Recognizing these diverging trajectories is just crucial when you're making investment decisions in this region. Can't paint it with one brush.
No, definitely not.
Yeah.
And while India does present some compelling opportunities for investment, our analysis also reminds us, importantly, about balancing this. You still need tactical hedges, right?
Oh, absolutely. Especially given the persistent geopolitical risks that always bubble up in that region.
You can't ignore those.
Never. Diversification remains paramount for managing overall portfolio risk. And remember, that extends beyond just different countries.
You mean across asset classes too?
Yeah, think about diversifying across different currencies, different sectors, and various types of investment instruments as well. Spread the risk.
This has been a really insightful exploration looking into these contrasting economic fortunes of India and Pakistan.
It's a fascinating dynamic to watch.
It really highlights the complex interplay between, economic policy decisions on the one hand and those hard geopolitical realities on the other.
They're deeply intertwined.
And it certainly makes you think, doesn't it, about how the ever-evolving dynamics of global trade might continue to shape these regional trends in the years ahead, where things go next.
Indeed. Constant change is the only certainty.